Hi everybody, this is Demme Wiggins. I'm pretty sure you can all hear me. If not, I know I'll hear about it from the moderators. So I'm going to get started. Today's class is on the World Fund. There isn't probably any one of you who hasn't heard about the carry trade, and this class particularly is for those people who are fairly new to the Forex. So if you've been around a while, you're not going to hear anything too new here. However, I think there are some interesting thoughts on the carry trade, particularly if you are new that been in the industry or been in this market for less than 6 months, that you have something that you can learn here. So let's get started. Okay, interest rates in the carry trade. Okay, the first thing that you need to understand about the Forex, particularly if you're new, is the Forex is a game of interest rate futures. Everything that happens in the market is about traders, whether they are individual traders like yourself or me, or if they are an institutional investor, or even some of the really big macro accounts are entering the Forex, and they are using the carry trade specifically all about the interest rates. They are looking for the spread between the interest rates. So, and I'm going to give you that in detail. So that's a real driver. So, and the bigger that spread, the more people and the more institutional traders are going to barrel onto the carry trade, and you'll see it start to take off. So in simple terms, when you trade a currency pair, particularly on the spot market, you are buying one and selling the other. The one that you are selling is actually a currency that you are borrowing in order to use that currency at whatever interest rate that is to purchase the other one. And so therefore the difference between that, those two interest rates is the difference that you owe the bank, so to speak, and that would be, or the bank would owe you, depending on how it goes. So carry trade is simply borrowing a low interest bearing currency and purchasing a higher interest bearing currency. And so the difference, is, for instance, if you go to the bank, if you borrow something at, 1% and then you sell it at 10, you're going to get 9% interest rate on that. Okay, obviously the bigger the better, and we're going to see some of those. Okay, and obviously for years now, the Japanese yen has been the real driver of the carry trade because it's consistently been the lowest interest rate currency out there. But that becomes a problem when the Bank of Japan starts to intervene. Okay. Again, it's a game of interest rate futures. And with the interest rate futures, essentially everything that's happening in the Forex is because the traders are out there and they are looking at that market and they're comparing economies. The economies are based, the evaluation of the economy is based on its interest rate. So whether you see that it's because manufacturing is down or jobs are up, whether it's in the United States or Japan or wherever, traders evaluate that information, or even something like Trichet comes out and says in Europe about indicating there may be an increase or decrease in the euro's value. Traders sift through that information and determine whether they believe that that's going to be a positive or a negative to the interest rate for that currency. Again, it's buy the rumor and sell the fact. And so, one of the things that happens by the time that a nation actually announces its new interest rate, or the bank of that nation, it's almost too late. And so when you see, unless it is a real surprise, like they doubled up or they stayed flat when it was expected to increase, unless it's a surprise, you probably won't see it move too much because the traders have already calculated that in, and so there isn't a lot of movement to make on that currency. Surprise interest rates changes. Okay, that's where you see some huge spikes in the market. Or if you see it do what it's supposed to, it may very well be that you see it do a short run up, a short spike, but then it drops again. So you see some movement, but it comes back down to where the institutional investors had already determined it was supposed to be. And it will actually change the market direction. Okay, so we have a course in the 1000 Pip Club where we actually evaluate interest rate sentiment, the FFIX, which is the Forex Futures Index, and so that where you think it's going, and so that becomes a driver as well as the trend on where you think that market is going. Okay, let's look at the difference here, some of the variances. Here are the current interest rates. And obviously the Aussie leads the pack at 4.5, and the yen is trailing behind at 0.10, which is effectively zero for the most part because they gave themselves a range. Let's say I listed this as a difference in basis points when in fact it's a difference in just a percentile difference. So you see the Aussie, the difference between the Aussie and the New Zealand is really 200 basis points. That's huge, but when you get down to the difference between the Aussie and the yen, 440 basis points, that's a great trade when the Aussie is going up. Not so great when it's going the opposite direction and that 440 basis points charged back to you. Then if you look at the New Zealand, at 2.5 versus the euro at 1.5, you start to see the numbers drop. So the difference between the Aussie and the yen is 4.4, whereas the difference between the New Zealand and the yen is 2.4, and you can see the numbers have almost cut in half here. And then it goes down. These are the numbers based against the euro, and you can see euro yen is still a good carry trade. Certainly not the best out there, but it's pretty decent. And the euro yen's a great pair to trade anyway. It's such a market indicator. So 115 basis points is not a bad deal on that one. But then when you get down to trading the pound yen used to be everybody's favorite to trade. It was a great spread. And you could see that pair just make huge moves in the day. You either kill you or make you rich. And so, I got to the point where it was just a little too volatile for me. So I pretty much stay away from the pound yen for a long time when it was doing that. And then when you get down to the pound these days, where it used to be the pound yen was the best deal out there, certainly not this day, not even qualify as much of a carry trade at all. So you can see that basically the way it works is that you buy the Aussie, let's say the Aussie yen, you're going to buy the Aussie and sell the yen. So Aussie yen is going to be a positive carry trade if you're buying it, and that you would make the 440 basis points. You take 10 lots out on that, then you're going to end up, or your leverage is 10 to 1, then you're going to end up with 44% improvement on your trade. So you're ending up, a 44% interest rate. So to your favor. However, if that pair starts to turn around, you're going to lose that pretty quickly. And I'm going to show you that you're going to lose it a lot faster than you will ever make it. And so we're going to look at that carry trades are great unless you're in a volatile market. Okay. Carry trades occur generally at the end of the New York trading day. And then so anything that's sitting there, any position can be a carry trade if there's a variation in their interest rates. you will see the interest accrued, or you will see it credit or debited to your account at that point. Any interest earned for the previous day is credited to the account, and any interest accrued is debited at that point. So you're either in positive status or a negative status for that day. Market is closed on the weekend, so everybody loves triple rollover Wednesdays, and that is when you see it compounded 3 times. So you definitely, if you're in a sell status on the carry trade, you definitely want to be out by 5 o'clock on Wednesday, if at all possible. Holidays are generally accrued 2 days prior. Now, this is important. Brokers will either not, in many cases, there are brokers who give you all of it, and there are some who assess fees, and there are some who will only give you back part of it. So make sure you check in with every broker before you sign up. The brokers I deal with only do give me everything back. I think one of them has a very small fee, but it's worth it in other areas, so I go ahead and work with them. But you definitely want to check with your broker before you set up a live account as to how they handle the swap. You'll hear that term a lot. They refer to it as the swap. Okay, let's talk a little bit about the carry trade. Carry trade, you will hear it referred to as risk on, and that is, or risk trades, and that's very true. When the market is reacting according to plan, and that means when the market is reacting according to the interest rates that are assigned to the currencies, it's a risk-on situation. And that is when carry trade buying occurs. Now, keep in mind, carry trade buying simply means you're purchasing the higher interest rate and selling the lower interest rate. It doesn't mean that you're buying necessarily that you're buying the pair. For instance, the Euro-Aussie. The carry trade on that one is to actually sell the Euro-Aussie, because the Aussie has the higher currency or the interest rate. And so don't get confused. If I'm saying that you're buying the interest or buying the carry trade, simply means you're purchasing the higher interest rate currency against and selling the lower one. So when the market is moving in a way that the higher interest rate currency is actually the ones leading the market and moving up, you have a risk-on situation, and that means traders, including large investors and the institutional traders, are all buying carry trades. In a situation where it's risk off, it's a different scenario. That occurs when something happens, the market is not trading according to plan, or according to the interest rates, and now you will hear it referred to as risk off or as flight to quality. And that we have a different terminology for it, and I'll give you that in just a minute. But essentially, in this case, it could be because somebody came out and gave traders an indicator that for instance, Greece really is going to default, or it could be anything that anybody has said, or it can be some severely bad numbers or severely good numbers on one currency or another that gives anybody trading a reason to believe those interest rates may change or reverse on either one of those pairs. Now, it may be that they're not going to unwind all of the carry trades out there, but they may adjust their positions, so you'll see some drop in the carry trades. Okay, I told you we have no terminology, and we don't use greed as a negative word here. This is a matter of investors or institutions determining that this is a good risk, that it's a minimal risk. They want to gain additional funds, and so therefore they're going to go into the carry trade, and they're going to do it. And you'll see that it's done very methodically. The traders will go in, they will buy the currency, and they'll buy the carry trade. It goes up, it will retrace on normal patterns, and then it will go up again and retrace, go up again, but it will do it fairly at a medium rate to a slow rate, and it will be done in a very calculating, methodical manner, and that's the way the carry trade should work. Now, in a case where it's a risk-off situation, the world change. Carry trade, purchasing and selling is all about emotion. So you have greed or you have fear. So it's either risk on or risk off. And that, you have some consolidation, which means they don't know which direction to go, but they're not afraid yet. But when you start to see carry trade selling, you definitely have a fear situation. And when people react in greed, it's a slow, methodical process. When they react to fear, it's not so slow or methodical. Because remember, with carry trades, when it is a risk-off situation, he who gets out first makes the most money or loses the least. And so it's really important, and you will see that it's not a slow process. We'll actually show you an example of that. And not only is it carry trade selling, it's also safe haven buying, which is why there are essentially three safe havens out there: the yen, the Japanese yen, the Swiss franc, and the U.S. dollar. And of those three, right now, the U.S. dollar is the one that is being the safe haven, simply because the Swiss National Bank and the Bank of Japan are doing their level best to prevent their currencies from being the safe havens. But generally the movement of the yen against the higher yielding currencies is the best indicator of carry trade direction. A couple things you'll notice when the Japanese yen, and I mentioned this the last time I spoke, the Japanese yen will tend to follow the Dow Jones or the equities in the U.S. And the reason they do that is because Japan is so dependent on the U.S. for its trade and for its economy is basically predicated on exports from Japan to the U.S. or to Europe or whatever, but especially from the U.S. And so therefore, when equities take a dive, you will generally see the Japanese yen start to falter. And as the Japanese yen then raises in value against the other currencies, that starts to upend the market, and you will see the carry trade start to unwind across the board. Okay, risk and carry trade activity. As you can see there, that we've got a very low angle here for carry trade, and you can it will. If you get in early on a carry trade and you can handle the big drawdowns, really recommend that you stay in it as long as the market looks like it's going to behave, so to speak, because you're nice, steady. You will take some drawdowns because of retracements, but that's the nature of the game. And over time, if the market stays and behaves, you're going to do extremely well. When you are participating in a risk off and selling the carry trade, you will see more of this angle right here. And you can make quite a bit of money in a very short period of time when a carry trade is selling, just by jumping in and selling off that higher yielding currency. But you got to be careful because you don't know when it's going to hit the bottom. Then those bottoms for the institutional investors, the ones who really drive the market, is already preset. They know how far, they know where their stops are going to be, and so you have to be very careful about jumping in there and, to take advantage of that. It's always, it's an opportune moment. At the same time, you have to know where those stops are likely to be, or you will get reversed and dumped out of there so fast, or you'll lose a lot of money if your stops aren't good. So you'll see this, and you'll see what happens here. Let me show you this. over here on the right, you see this is, let me just to give you a set here, I think this is the Aussie yen, and it is moving up here in terms of carry trade buying. See, it has a pretty big move up. It retraces as normal. Has and this is the weekly chart, by the way. So these represent a lot of days of movement. So then it goes up again, another drop. You can see then it drops and it threatens this stop right here, this resistance or support, before it starts up, and you can see the movements are not as much, and you've got some consolidation in here, but it stops here. So over the course of that time, which was 8 months, you could have gained 2,976, almost 3,000 pips over 8 months. It's not a bad move. On the other hand, over here is when fear set in and it starts to fall. You had almost a 5,000 pip drop, and it took 3 months to do that. You can see there's a big difference, and you will find this. Look at your chart, and where you see big movements up or big movements down, you can tell which one is the carry trade, whether it's up or down. And it will tell you every time that you've got some fear and you've got some people going that flight to quality. I think that's why they call it flight to quality, because there is a lot of fear in that. So that is it. But you will see that consistently from across the board. So I am going to look and see if there are any questions. It doesn't look like there are. And then I'm going to turn it over to Mayor Vaughn, who is going to pick up and talk about some market.
So I've just summarized here what we covered last time. Now, you may find me repeat important things sometimes, and I do that intently. And I do that because I do appreciate there are some to most new people in class. From what we kind of surveyed earlier, most of you are between basic and kind of intermediate, what we would call. So a little bit of repetition is good. What we will be covering throughout our session, so last week's class was on support resistance, Fibonacci retracements and extensions, ATRs, or what you may refer to also as the average daily move, parallel and inverse pair relationships, and chart reading and using multiple time frames. Now, there's more to this, but this is what we'll be focusing on at FX Street, and this is extremely important. It's how you use this stuff to identify your trade and get into a trade, okay? Now, I just wanted to kind of bring this front and center. So if you missed something from last time, go back and check it out and try and get better at this. And it's again, get better at this and apply it in real time. That's how you get better. Now, a equally important element is that you begin to use your trading platform. You get very good at using a trading platform and apply all this there. So what I want to do now, and what I'll do next week as well, is share with you how to do that. Okay. So what we said. Okay, let me flip back. What I want to share essentially is how to read your charts, right? Now all these lines might look a little bit crazy initially. It did to me earlier when I started out, but as you get good at this, there is tremendous value of doing your homework, and you must have heard this from many other people if you're regular attendees at FX Street webinars. There is tremendous value of having a trade plan. There's a tremendous value of doing your homework, knowing what you're getting into versus just, from the seat of your pants, some news comes out or some support resistance hits and you go, boom, let me go short there or long here without a thorough analysis, okay? How do you come up with these lines? What are these lines is what I'm trying to demonstrate in the next few minutes, okay? And once again, like anything else with experience, you'll get very good at this. So what I'll do is I'll pick up on Euro. Now, I did, if I recall correctly, I did went through Euro last time. And we kind of suggested a few price. Once again, any price points to give out in class, please, folks. That's only for demo trading purposes, especially if you're new or intermediate. If you're an experienced trader and if you know what you're doing, great. But this class is mainly for educational purposes, only trade demo for that purpose. I'll throw on a couple of lines here. I'll show you how to draw fibs. I'll show you how to draw support resistance lines. I'll show you once again what is multiple time frame, why we use that, all that stuff. So we'll do a lot of practice here. And if you're new again, you hopefully will enjoy it a lot. So this is a daily chart. Once again, D1 is daily. So I'll start with M1. M1 is monthly. The roller on my mouse, as I roll that roller on the mouse, my chart can expand or contract. And I haven't used, but I'm sure there are other features here that do that too, but I enjoy using the mouse for that. So very important feature. Starting from the monthly side, as you can see, there's a trend, there's a bearish pattern. And the reason I see a bearish pattern on the monthly is because there's the top there. There's lower highs and lower lows from a purely technical standpoint. Lower highs right there, 60.37. Next one, 51.40. Next one, 49.38, and similarly lower lows, 23.28 and 18.75. By the way, I personally think, and guys, again, getting in the pair is the right time is important. But I personally think, and I've been calling it out for the last 6 months, I think it may hit or break 1875 over the next few months, the way it's going. Okay. Okay, so that's a monthly chart. Now, if you start focusing on the right side, essentially from 1439, and just to show you visually, if I drew a line right there, okay, if I drew a line right there when it started as a downtrend, and I go on the weekly, do you see how much more data do you see? You see much clearly more data. Even on a weekly basis, you can see it's trending down. There's a bearish trend. Once again, lower high, 49.38, so on and so forth. I won't go through all the details, right? Now, if I draw another line on the daily, right there, from where the recent short trend started, and go down to my daily chart, once again you'll see over the last few days, right, whatever 2 weeks or so, it's also been trending down, right? So right there, what I've just done between monthly, weekly, and daily is multiple time frame. Now, you can of course keep going down. I personally don't bother with, and it just comes down to what looks good to you and to your eyes and what you want to do. But I personally focus on monthly, weekly, daily, and I go straight down to the hourly chart. Occasionally, I might come back to the H4. But for instance, if I want to focus now on down to this level, right, from October 21st, 2011 down to today, all I need to do is go on my hourly chart, right, and scroll a little bit. You see that black line at the end, and I have enough data to analyze whatever I need to analyze. That's really what it is. And once I have my hourly, right, and I have to figure out what the heck is happening, let's say over the last few hours, let's say if I pick up this stop here and I draw another line to figure it out, I might go down to a 15-minute or a 5-minute, and that would be sufficient for me to figure out what's happening in real time. So I can see it kind of went sideways, and right at about 3:35, 3:50. This is Eastern time, by the way. I'm on the Eastern time zone, so this is another reason why I prefer these charts. 3:50, 3:55 started dropping. Now, when I see a drop like that, I wouldn't be surprised if I move down to some of the other pairs, like Aussie right there. Right there. See that? I'm on the Aussie now, on the 5-minute. Right there, 3:50 started dropping together. More times than not, when you see a drop like that, you would see all the risk currencies, as we refer them, Euro, Aussie, where's my Kiwi here? Where's my Kiwi? There it is. Right there. See, it's almost to the minute it'll start falling. And that has to do with the safety of the US dollar. US dollar is one of the three safe havens, US, Swiss, and yen. I mean, I don't want to go off topic. Let me get back on how to use the charts, okay? So let me get back to last week when we covered the euro. And let me remove these lines down. So the way you can remove these lines is just select them and hit delete, and they'll be off your charts. You have to kind of get a little bit comfortable and familiar with it. So last week we looked at a couple of things, right? As I said, daily is a big enough time frame, and daily should be a front end center. Once you figure out what's happening on daily, you can go back to weekly, monthly, or you can start from monthly, come down to weekly, how you prefer. But daily should definitely be a front end center, and then kind of going down into the hourly chart. So just based on the daily, and I may not do it precisely, or rather I will do it precisely just to show you. The way you add Fibonacci is just kind of select the Fibonacci icon. Just click on this. Go up top here. Now you may not be precise, and I'll show you how to come back and do it precisely. Just draw the line, extend it down, leave it. You will see this box come up. Now the first time if you're doing this, you may not see all of these selected, like 0.0, 0.2, 0.382, so on and so forth. You may not, and I don't recall this since I've been doing this for a long time, you may not even see, let's say 23.6% or 0.36, 0.236 or the 0.764% level. If you don't, you can just click add and type that level and then keep it there and set it as default. When you set it as default, those levels and whatever colors you have, it'll be set as default. You can always change it as you want it to. Okay, so let me proceed. What I do, just to make sure I don't go completely crazy with all these lines, is I kind of came up with some kind of a logic that made sense for me. You can figure out what makes sense for you. This is not MetaTrader 4, this is FXCM. So you can go on fxcm.com. I mentioned this last time, and download the trading station. And the reason we kind of like these charts, and again, I'm not suggesting you sign up with a broker. You have to do your own due diligence. I'm suggesting the charts are good enough, and these are the charts we'll be using to kind of go over our currency analysis classes over the next few weeks. So back on this. Just to make sure I don't completely go crazy. And the reason I say that is because when I go down to my hourly chart, for instance, I can see a lot of lines, okay? But when I see a green line, for instance, a thick green line, it resonates very quickly with me that this is a Fibonacci level where I was going from low to high. Let me show you that. And that's probably on a monthly chart. So let's say on a monthly chart, if I'm starting out from 82, 30, all the way up to 60.37, I'm going up. So in my mind, I kind of use the green color just to signify I'm going up. If I'm going down from 60.37 to 18.75, I would use a red. Once again, you see 18.75 back to 49.39. Going back up, I'm using a green. And then it comes down to some of the recent time frames, I'm using blue, and then I kind of start using pink and the reason, yeah, I know it's a work of art. Trust me. And I do appreciate it. It can get confusing initially, so use it as you want. For me, it's helpful because can you imagine when I get up in the morning and I look at my pairs and it hits my numbers? Sure, 5 display. When it hits my numbers, I don't have to worry about too much. I definitely do my homework still 15-20 minutes and try and figure out, but I don't have to do all this every single day on all the 28 pairs. It's done. It's ready for me. Okay? I can pick up any pair, just go in my snapshots, open a snapshot right there. I've got any pair sitting ready for me. All I have to do is click it, open it, update the time frame, and I'm good to go. Okay, let me come back on the chart and show you how to draw these lines. So last week we were going through once again that one was coming down. Going back up, we can choose, for instance, this one, right? And one more thing, if memory serves me right, oh, hang on, let me just see something there. See, I'm changing the color, right, just to kind of reflect green and red, right? And the third one we did was this one coming down, so I'll probably choose a different color just so it stands out a little bit. So just select the color, the high to low, draw it out, and let's choose blue now, right? And what I do is I choose the fib lines and also the trend line, so to say. So it kind of sees blue, so I can see red, green, and blue. But here's what it does for me. You see that 38.2% level, how many times it crosses over? Folks, if you were not introduced to fibs so far, let me tell you, this is one of the most, if not the most, it is one of the most important tools that you should get comfortable with using. It works. This is what the big time funds definitely use along with support resistance. So you can go back and check the class. Last week I did mention 38.22 to 38.50 levels that seem decent, and I said that just based on technical analysis. That's what technical analysis is. Now, I of course also noted a couple of support resistance levels in the class. The way you draw support resistance levels, you see this pencil there, add line. You would click this down arrow and go down to the add horizontal line, right? And select that level. Now, what I do to be precise is I can draw the line or do this first, whatever, but I always try and figure out what the precise level is. And the way you do that on FXCM is click the candle. Just click it once, left click. See that low, 38.36.3? Once I figure it out, I would double click the line open and make it precise, 38.36.3. Now, I do prefer, still kind of in my mind, keeping it at times, I'm used to that old school of thought, 4 digits, you can do the 5 also, doesn't make a difference. But that makes it precise, okay? Same thing with the fib lines. If once I draw it out, I will go and click that candle and figure out what the top was, 49.38.9. And if I don't have 49, okay, I don't have it right, 49.38.9, 40.38.9. So I would click it, go on the trend line, and the top is 38.9, 389. Likewise, I would do the bottom. I'd do the bottom as good 44 something. Okay, so I would do that. Now that takes a lot of time for me to make one of these charts like this, right? It takes good at my level it takes about 15, 20 minutes or so. If you're new, it may take you a couple of hours, but that's the amount of, if you want to learn, you kind of gotta pay the price. Okay, going down to support resistance, another level, excellent level on the euro is this monthly one, back from July 1995. The top here is 38.22. That's another level that I'd identified last time, 38.22, 38.22. And what I'll do there is just to kind of show it clearly, I'll use a orange color. I'll kind of, and this is what I do all the time with myself, thicken it up a little bit so it stands out a little bit different. If I'm doing my homework overnight and I want to see something, if it pops in the morning and I want to get it, then I'll definitely choose different colors and so now let's go back to the daily chart and see what happened. This is what I went through last time. Okay, there are 3 fib levels, 38.2, and just so I don't confuse, let me take off the other levels. Let me take off the other levels so you don't get confused. And you can do that again at your end. I'll take out the 23, 50, 61, 78. Right? And double click this one, and that's 38. That's the other one I'll focus on. 38.2 is a very important fib. I mean, fib, so is 50, so is 61.8. But okay, let me see. Take this off. 30.2. I'll leave it there. So now you can see very clearly what I'm trying to say. Based on these 3 fibs, just off the daily chart, which is a very powerful long-term chart to focus on, you can see, and support resistance lines, right? And now if I go down to maybe my hourly chart, you will start seeing it a lot clearly. You will see that 38.22 to that 38.50 level I discussed last time has held up. I did also say last time, and I stand by it, is can anyone give you a guarantee For sure. If my life was at stake, if my property was at stake, would I put it all on the line based on that analysis? Absolutely no. Because I have no idea what statement will come out as I speak in an hour, in a day, from Merkel or Sarkozy or Mr. Berlusconi from Italy, or Paparandu is gone as somebody else. Someone may come up, especially the current volatility is so significant that nobody can guarantee. You also heard this term, that the market can remain irrational a lot longer than you can remain solvent. So try and think to that statement. I'll say it again. The market can remain irrational, irrespective of what you think about trends or fundamentals, right? Look at what happened to MF Global. So they can remain irrational far longer than you can remain solvent, okay? So that is why you need to have tight stop losses. That's the reason. You cannot afford 100, 200 pip stop losses. So at the 1,000 pip club, we try and 20, 25. I kind of go for 30 also at times. I know Jeff does it far less. At 15, he manages to get it. And that comes down to a lot of experience, a lot of the extra stuff that we share in the 1,000 pip club. But just to point out that since our class last week, so last week was, let me go down and check what last week was. It was Wednesday 2nd. Wednesday 2nd, this is on Eastern time frame. Our class is from 7 to 8 a.m. in the morning Eastern. So where was I? Yep, there. Yep, so let me just put a line. I was in class around this time frame, 7 to 8. You see those two lines? That's 7 to 8 last week, right? It came around there, and the other reason was, folks, and I can't keep going back and forth on the charts, but remember the 4 things: support, resistance. Let me ask you guys. Let me see how much you're paying attention. And I know I'm running short of time, so 5 minutes I'm done. What are the things you should keep in mind? Support, resistance. What else? Support, resistance. What else? I want some folks to participate now. I want to see how much you're paying attention. Support, resistance, Fibonacci's, supply and demand. Okay. Well, supply and demand drives your pair going long or short. Great. And that does kind of imprint on the charts support, resistance. But support, resistance, fibs, ATRs, daily moves. Okay. Don't just depend on the daily moves, but it's a good gauge. And parallel inverse. Thank you so much, Mighty. Parallel inverse analysis. Why is parallel inverse analysis important? Let me show you in real time. See this EURUSD, how it's going, how it's flying down. I can go down to Euro Yen and see what's happening to Euro Yen. Look at that. It's flying down. Whereas, 5 minutes left, thanks. Whereas not much is happening on the, if I go down to the USD Yen hourly chart. Yeah, it's kind of spiked, but since 4 a.m. it's kind of going sideways almost. Whereas the Euro and the Euro USD going short is driving the Euro Yen to go short. That's kind of your parallel inverse right there. Anyways, I wanted to show you how to draw the lines. The last thing I want to show you is how to save them. So after you've drawn all those lines, right, the way you save it is go to File, go to Snapshots, save Snapshots, and type it in. So what I would type in this case is EURUSD, I'll just say FX Street class, okay, just so I don't lose my own original EURUSD. And save it. And here's what I'll do. I'll shut off everything just to show you how easy it is once you start in the morning or over the weekend or first thing on Sunday. You go to File, see everything is blank, there's no chart here. You go back to File, go to Snapshots, open Snapshot, and this is the one I just saved, EURUSD FX Street class. You open it up, and voila boom, you have it right there. Isn't that great? Try it. Okay, I'm done. If you have any questions, let me know. By the way, if you guys have any questions on the side, you can always feel free to email myself or Demme. Demme is Demme, D-E-M-M-E at 1000pipclub.com. Myself is Meherban. My name is Meherban at 1000pipclub.com. We'd be happy to help. All right, I'm done. Thank you. See you next week.